All right, let's talk about financial freedom. I mean, it's the big one, right? The ultimate goal for pretty much all of us. But what does it actually look like when you get there? Is it about having this giant pile of cash, a massive nest egg? Or is it more about having a steady stream of income flowing in from your assets, enough so that your paycheck becomes, well, totally optional? That's the big question we're going to dive into today. It really boils down to two main schools of thought. On one hand, you've got the asset approach. This is all about hitting a big number. You've probably heard the rule of thumb, right? Save up 25 times your annual spending. Then, on the other hand, there's the income approach. This one says freedom isn't about the size of the pile, it's about when your investment income is enough to cover all your monthly bills. So it's really the classic nest egg versus cash flow debate. The big question is, which path makes the most sense for you? So to help you figure that out, we're going to break this whole thing down. We'll kick things off by looking at the super influential Rich Dad Playbook, which is like the poster child for the income approach. Then we'll get into the good stuff, the pros. But we're also going to get real about the cons and bust that myth of passive income. And finally, we'll wrap it all up with a more balanced strategy that takes the best of both worlds. Okay, let's jump in. All right, first section, 2 paths to freedom. Look, before we can even think about picking a path, we all have to be on the same page about where we're going. So let's lock in a solid definition for what financial independence even is. Okay, here's the absolute key takeaway. Financial independence isn't about turning 65. It has nothing to do with age. It's all about a number. The simplest, most direct definition is this. It's that point where your assets are generating enough income to cover all your living expenses, so you don't have to work anymore. It's that magic moment when your money is officially working for you instead of you always working for it. And that idea, that core concept of making money work for you, well, that is the absolute foundation of the Rich Dad Playbook. I mean, this is a philosophy that has literally inspired millions of people to completely flip their perspective on how wealth is built. It really all kicks off with this one single lesson from Robert Kiyosaki's Rich Dad, Poor Dad. And it's a game changer. The rich don't work for money. They make money work for them. Think about that. That is a massive mental shift. It's all about going from just being an earner, trading your time for a paycheck, to becoming an owner. So you might be asking, okay, how do I actually do that? Well, it all comes down to understanding this one super simple but incredibly powerful distinction. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. Seriously, that's it. That is the entire game right there. And this really lays it out perfectly. On the left side, you've got your assets, things like rental properties, dividend-paying stocks, and they're all creating a flow of cash into your pocket. Then on the right, you've got liabilities, your car payment, student loans, credit card debt, and all of those are pulling cash out of your pocket. The whole strategy, the whole secret, is just to make that left side bigger and bigger while you shrink the right side down to nothing. So this leads us right into the core strategy, which Kiyosaki calls mind your own business. And the key here, and this is a big one, is that you don't quit your job, not at first. You keep that day job and you use the income from it to just aggressively buy real assets. All the while, you're crushing your liabilities and expenses. You just focus relentlessly on growing that asset column until the income it produces is enough to set you free. Okay, so that's the dream, right? It's a really powerful idea, it's easy to grasp, and it has some serious advantages. So let's dig into the pros of this income approach. Let's really see why this strategy is so incredibly appealing and why it works so well for so many people. So there are 4 really big advantages here. First off, the finish line is crystal clear. I mean, when your assets are spitting out 10 grand a month and you only spend 10 grand a month, boom, you've arrived. It's that simple. Second, it's just behaviorally easier to spend money in retirement. You're living off the income, the golden eggs, not selling the goose itself. Third, this approach often means you end up leaving a much bigger inheritance to your heirs. And last but not least, if you're comfortable with things like leverage or entrepreneurship, this can be a way, way faster path to financial freedom. But, as with any strategy, the devil is always in the details, and there are definitely some potential pitfalls. And that brings us to our next section, the income approach cons. Yeah, this is where we get the reality check. And this is where things can get a little tricky. If you focus only on income, it can be super tax inefficient. It can also push you into making some, funny investment choices. You also run this weird risk of actually oversaving and working way longer than you need to. And maybe most importantly, those so-called passive income streams, the highest paying ones often require a ton of active work. Let's kick this off with the tax trap. The problem is actually pretty simple. If you're building this big income portfolio while you're still working your main job, you're just generating way more taxable income than you actually need to spend right now. As our source, the White Coat Investor, puts it, from a tax perspective, you don't want to ever have more taxable income than you actually need to spend. It's just not a smart way to do it. This focus on income can also lead you down some weird paths, into some, let's call them funny investments. For example, let's take junk bonds. They offer a crazy high yield, which looks amazing if you're just chasing income. But here's the catch. What's often happening is the fund is just giving you your own money back, your principal. So the asset itself, the bond fund, could be slowly losing value, even while it's spitting out that so-called income. That is definitely not a winning formula. Peer-to-peer lending, same story. You see these platforms promising these just insane interest rates, right? Like 15%, 20%. But that's the yield before you account for defaults. As soon as people start failing to pay back their loans, your actual real total return drops a lot. And if you're spending that entire high yield as it comes in, you're basically just spending your own principal as it gets eaten away by defaults.
And believe it or not, this same exact concept applies to real estate. You might see a property with a really high cap rate, which is basically just a fancy way of measuring its income against its price. A 12% cap rate sounds incredible, right? Tons of cash flow. But often that super high number is a red flag. It might mean the property is in a rough neighborhood and is actually depreciating in value. Meanwhile, a property with a much lower cap rate, say 3%, might be in a great area that's appreciating like crazy. This just hammers home the crucial point. It's all about total return. That's the income plus the growth. That's the number that really matters.
And this leads us to what might be the biggest misconception of this entire approach. We've got to talk about the myth of passive income. Is this whole thing true financial independence, or are you just signing up for a new job? Look, the truth is, passive income isn't a simple on or off switch. It's a whole spectrum. On the far, far end, you've got stuff that is truly passive. Think bank interest or the dividends from a broad index fund. But way over on the other end, you have things people call passive, but they're really just businesses. We're talking about managing 100 rental properties, running a profitable blog, or spending your weeks evaluating new real estate syndications. Let's be honest, that's not retirement, that's a full-time job. Which really forces us to ask ourselves a very blunt question. If you're spending 40 hours a week managing all your passive income streams, have you actually reached financial freedom? Or did you just change jobs? So where does all this leave us? Well, it's time to put the pieces together. We need to build a more balanced, a smarter strategy, one that combines that inspiring dream of passive income with all the nitty-gritty, practical details we've just talked about. So here's the quick recap of what we've unpacked about the pure 100% income approach. The pros, they're really appealing. You have total clarity on when you've hit your goal, it's way easier mentally to actually spend your money, and you'll probably leave a huge inheritance. But the cons are serious. You could end up oversaving, it's really tax inefficient, it might trick you into making bad investments, and that so-called passive income is often a ton of work. So what's a smarter way to move forward? It's probably a hybrid approach. You absolutely should start with that powerful rich dad mindset. Get obsessed with buying assets. But, and this is a big but, when you analyze those assets, you have to look at the total return, not just the shiny yield. And you have to be brutally honest with yourself about how much work is actually required for that passive income. The real goal here is to build both a solid nest egg and some smart income streams on the side. And that really leaves us with one final big question for you to think about as you build your own path. Take a hard look at your own financial strategy and ask yourself, is what you're building leading to true freedom, or are you just building yourself a more comfortable cage?